Good morning and welcome to the Mortgage Market Update with David Luna. Please let me introduce the President of Camp, Ms. Audrey Boissonneau. Audrey?
Good morning. Thank you so much, Megan Jackson, for all of your help. Thank you to Kevin Casey for being here and our favorite little friend of the hour, David Luna. I just want to let you know what else is going on this week with Camp. On Thursday at 11 a.m., we are going to have Anthony Hutchinson. He is with Freddie Mac, and you can ask all sorts of questions and see what's going on with them. And then on Thursday evening-ish at 5 p.m., we're going to do our every 2 week now camp social hour and brainstorming mastermind session. It's evolved into that, and it's interesting. It's very casual. It's very, you never know who's going to turn up, and it's really lovely to see a lot of familiar faces and new faces. So please join us for that. As always, please feed your questions through the chat box. We always look forward to answering those questions, and make sure, please, that you join Camp or renew your membership in Camp. We are a grassroots industry association, and we depend on your support. So with that, David, it has been a different, we are in week, 5 of things not being horrible.
I would call it all good news. So let's start off with the jobs. So the jobs report in May was expected to be an additional 7.5 million, put unemployment close to 20%, but we didn't lose the jobs. We actually gained 2.5 million jobs. So that's a positive swing. If you take 7.5 and 2.5, that's 10 million people going back to work. I think it's super, super cool. And though we can be happy and smiley, it's important to remember that although the unemployment rate was better than expected, it's still over 13% instead of that 19 to 20%, which is still very, very high. So yeah, total claims has fallen for 10 straight weeks. Of the 40 million,
do you think? Wait, what?
Of the 40 million unemployed, 20 million are back. So, this is good stuff. What were you going to say?
What do you think about the, I've heard some chatter about the March, April, and May numbers being skewed, and that there will be some pretty significant revisions in the next jobs report. So what do you think?
Every time the numbers come out, they're always changed. Up, down. Consistently we were seeing monthly numbers of 200,000 jobs, and then all of a sudden, well, no, just kidding, it wasn't really. So that happens all the time.
Doesn't that drive you crazy though? It drives me crazy.
A little crazy.
They release these numbers, it moves the market significantly, either for the better or the worse, great, whatever. But then they come out 6 weeks later like, okay, we were wrong. And I'm like, okay, what this does to the market. Why don't you get it right the first time? Why don't they get it right the first time, David Luna? Tell me right now. Makes me nuts.
I don't know. We rely on a whole lot of they rely on a whole lot of different sources for their information, and maybe the sources that they get their information from are just a little bit bad.
I'm going to put that on my to-do list for next year.
It's good for the mortgage industry because, borrowers have to have a job, to pay back these loans, whether they're buying or refining. So, somebody's got to take advantage of these historic lows, but they do have to have a job.
Do they? All right, you're right.
They do.
Great.
They have to have that ability to repay. Yes, they do. But you know what? I was I don't think it was my loan. I was talking to somebody recently. I had a loan officer send something over to me, and apparently the person was working on a commercial construction project, and all of a sudden people started getting sick. And this is kind of before the COVID thing, like March, right? And within a short period of time, like 50 people were all sick, and they go to the hospital, and boom, it's COVID. And so the commercial construction thing, boom, totally shut down. But when it shut down, he's going, oh my goodness, what am I going to do? So he called his mortgage company and asked, okay, what are my options? And they said, we're going to put you on a forbearance, which, by the way, they forgot and they didn't do, which means he was going to show up late. Stop. He then, got better. He had, reserves. He made his payment. He never missed. And then he got a new job, an even better job, more income, you know, kind of a job. But now he's sitting there saying, let me take advantage of these these low interest, interest rates. And it's like, nope, can't help you, can't help you. You were COVID-y, you were late, you were whatever. And he's like, I never, and this loan officer is saying, Dave, what do I do? And I said, just like you explained the facts to me, you got to go explain it to the lender. And that's going to be a pretty lengthy, you know, letter of explanation, but you're going to just have to explain what you just shared, that he never got late, he never went into forbearance, he's got this good job, he's back to work. I mean, just try and save the deal.
But he was never late. He was never more than 30 days late.
Nope.
Yeah, I'm hearing about this pretty regularly, actually, where people are, and they're hitting a wall with their lenders. And I'm like, you got to fight with that. But the first thing I told them to do, I'm like, document that you made your payments. Just get that ready just to begin with. Don't try and talk them into it. Don't just, don't tell them what the deal is. Show them. And they can't legally mark them as late if
they
he
never
wasn't late.
Yeah. So I think
So it's just showing, it's a coding on the credit report.
I mean, he made it later in the month, but he didn't go like 30 days. He might have been, you know, like 20, 23, 25, you know, whatever, right? He was later, but he was never 30 days late. So, you know, when we talk about they have to be working to take advantage of these low rates, I'm seeing more and more companies offering below 3% interest rates on a 30-year fix, both conventional and government, and high balances. I don't know, Kevin, were we talking just now about, you know, where
it's the high balance I'm running into in my world, you know, in San Francisco with the high balance, the retail guys are killing us. You know, I'm seeing like on a jumbo, if I can squeeze out a 375 on an ARM for $1 million loan amount, you know, I'm pretty stoked. And then, you know, I can find out that my clients can just call a Chase, or Wells rather. Wells will give them 2 3/8 on a 30-year fixed, no points. Like, you know, how do you compete with that?
Yeah, you can't.
Don't tell anybody. And that's like, and then I'm most tempted, like, tell my clients. I start telling my clients, you should just call Wells.
All over the world, you know, and you just told them. But anyway, you know,
but I also think that they have a real track record in the last 3 months of not following through. So specifically Wells, they had a borrower who signed their loan docs on their $1 million loan, signed loan docs were 4 days away from closing, and they pulled the plug. So, okay, so hopefully you get your rate. So, and then I had another guy who just went to Chase, and he got all the way to underwriting and then was told, we're not doing cash out refinances, even though his loan to value is 50% or less. His, you know, he's perfect, right? I'm like, how did your loan officer not know that they weren't doing cash out refinances? Like, I didn't get it. So again, it's not to single out the banks, but it's to say that your loan officer really matters. Like, whether they know what they're able to do or not to do, it matters. So make sure that as an LO that we're all letting our borrowers know what we're worth, so that that whole rate conversation becomes slightly less important if they're more interested in closing their deal, actually.
I have one cash out refinance where, you know, I was getting that brick wall, and everything was right with the file, but, you know, they were just saying, no, we don't feel comfortable doing this cash out refinance right now. And I literally just took it to upper management, and I had docs out in 2 hours, like done.
Ouch. So ouch that it almost blew up. Yay that you saved it. And again, it really pertains to the loan officer being super, super professional and knowledgeable and what's going on and how to solve problems and things like that. Hey, the recovery, we didn't know whether it was going to be that Nike swoosh, a W, a V. It really looks like it's becoming more of a V-shaped recovery. Retail figures are just showing that the economy is rebounding faster than everybody thought, which I think is, you know, good news. I mean, going back to work, and restaurants are up, and car sales are up, and just everything's looking really, really good. How's it looking in you guys' neck of the woods?
Other jobs are being created too. It's not just, you know, whilst not all restaurants are reopening, there's a lot of other jobs that are now being created. Like on the retail side, you know, they need more employees to manage, you know, staff. Like I stopped in at Home Depot yesterday, and like so many employees now there that they didn't have before. You go to, you know, there's a lot of people being hired for those types of jobs. You know, the banking is hiring like crazy. There's a lot of jobs that are being created right now that, you know, replacing the jobs that were lost.
Yeah. So I'm seeing all kinds of hiring signs all over the place. And so I think that'll be great. But, you know, as people get back to work, we really, really, really need to get people back to the home building sector because with that lack of inventory, appreciation should continue to go up. And Audrey, you and I were having an offline conversation where appraisals should be coming at or above value. And you had one where the appraiser said, you know, due to declining something or other. Do you remember what we talked about and how you had to say, what? What do you mean declining?
Sure. And I rebutted it and we won. I mean, that's either lazy or that is ridiculous. So it absolutely, sorry. Yeah, that is absolutely not happening.
Just like the rest of us, Audrey? You're like the rest of us?
Yeah, no.
So anyway, she had, two or three different appraisals. All of them were coming in, you know, workable. And then she had one where it was just below value, and the appraiser's comments were, yep, because everything's declining. And Audrey goes like, what do you mean declining? Where is it declining? And so Audrey told me that she challenged it, and Audrey, you won, right?
I won. You've got to make sure that you're not just taking this stuff lying down. Know what your market is. What I do is I just get on the phone and start calling realtors. I'm like, okay, you have to check and make sure you're right first. I mean, don't go in guns blazing if you're, you know, not positive, but definitely don't just take it at face value. And if it just seems wrong, it's probably wrong. And by the way, you almost just met my dog, Stella. She came to visit. She didn't know I was in a meeting.
But you explained it to her and Stella's okay now.
Did you hear her howl? She was literally like, let me in. So anyway. You
could have jumped up on your lap while you were talking and hit a computer key. It would have been fun though.
You haven't seen Stella. Stella's 50 pounds of fluff. So yeah, she's a Samoyed. Anyway.
Okay. Hey, this past week, the CFPB kicked out a new charm booklet. Okay. So I don't know. Well, maybe I understand their timing. So in the middle of the lowest fixed interest rates like ever, I don't know that the industry is going to be using it immediately, but there again, Casey, you were just talking about pricing out $1 million loan on an ARM, right? 3.7, 3.8, something like that. I don't know what you said. So this thing explains, you know, for the newbies, index, margin, the entire industry is moving away from LIBOR in 6 months. So the CFPB's timing couldn't be better. It explains the adjustable interest rate table and tells consumers, hey, you're going to get an ARM. And, you know, the agencies are moving away from LIBOR because LIBOR is going away 2021. So maybe the CFPB's timing was sort of kind of okay, you know.
What's the date in 2021?
Why are we moving away from LIBOR? Don't you teach this in CE?
Oh, yeah.
What's the date in 2021, David?
Do what?
What's the date in 2021? When does it go away?
Well, in the U.S., Fannie and Freddie move away from LIBOR. I mean, if you do one, they're not gonna buy it. In fact, they're explaining right now that their timelines start July 1, 2020. They're saying that, you know what, if you were already talking to somebody and you did a LIBOR ARM August 3rd, we would like to start migrating away from LIBOR and go to SOFR. So just look at it. Boom, in 2 weeks, July, then in a month, August 3rd. But by December, 6 months from now, they're saying we are not buying LIBOR at all. They're just totally moving away from LIBOR.
Who's doing Fannie Freddie intermediate ARMs? Wait. The last time I looked at it,
there was Kevin talking about pricing out an ARM. Kevin, back me up.
Wasn't Fannie Freddie.
Wasn't Fannie Freddie. That was good Lord. I'm like, last time I looked at one of those, the price was worse than a 30-year fix. So why would you do that?
Why would you want to go with an ARM? However, However, there might be somebody
If
out
you
there.
had told me in February that right now I would be doing mostly conforming loans, I'd have been like, you're out of your mind. I haven't
Well,
done it.
also right before we started, didn't you also say that 3 or 4 months ago, if you would have said you would turn away $2 and $3 million transactions, you'd say, Dave, what the heck are you drinking, right? And isn't that what you're doing right now?
And I'm going after the $100,000 loan and the $200,000 loan. It's like wow.
on purpose. That's a conscious effort you're making towards it.
Actively recruiting these loans. I actually stop people and say, hey, listen, can you do me a favor? I normally don't do loans under $500,000 very much, but I really need them right now. Who do you know that's only owes $500,000? I can really help them.
I've heard FHA come out of Kevin's mouth more in the last 4 months than I have in the last 5 years. I don't even think he knew what an FHA loan was before COVID. So there you go. Okay, so what else you got, David?
Fannie and Freddie have chosen their financial consultants. So Fannie picked Morgan Stanley. Freddie chose JP Morgan to act as financial advisors to guide them out of conservatorship. So I guess it's getting closer and closer and closer. You guys have a time frame when that's going to happen?
I was just going to ask you, do you think it's going to happen by November?
Oh, heck no. No. Way too soon. Remember, they're trying to accumulate like $240 billion.
Right.
But they're not going to do it by November. So it's not going to happen.
If it doesn't, okay, so I'm going to be interested to see this play itself out. And just for the record, this is not a political comment. Every once in a while, someone will go, don't get political. This is not political. This is merely a question. So we know that the current administration is very interested in getting them out of conservatorship and moving that thing down the road. If there was a change of administration, I'm wondering what the difference would be. And I'm not saying it's good, bad, or indifferent. I'm just curious, like, would they continue to push also, or do you think it would stall?
No.
Really?
Here, let me take a long time, think about it, and kind of
right.
No. Because FHFA is, FHFA is the regulator over Fannie and Freddie. So FHFA and their director, Dr. Mark Calabria, that has been on his agenda. And even before he was director, that was his agenda, is no. We got to get these things out of conservatorship. But think about it. That was what, 2008?
Yeah.
And here we are, 2020. That's 12 years. I mean, realistically, to our audience,
organization that was taken over by the government.
If our audience has been doing this for, let's say, 20, 30 years, half of their career, Fannie and Freddie been in conservatorship. So isn't it about time anyway? Everybody else is out from under that umbrella. So Fannie and Freddie probably should be as well. My opinion, sorry. Not trying to be political. I just don't think it's going to happen in November, and it will happen. Doesn't matter if there's a change in president or not. It's still going to happen.
Right. Yeah. All right. Good to know.
You want to talk about lawsuit? You want to talk about lawsuit? Okay.
God,
so we have a lot of folks on this call that are also real estate licensed. Okay. So there's been a lawsuit between TAN and NAR. TAN is Top Agent Network, and NAR, National Association of Realtors. Now they got chapters all across America, but specifically in the Bay Area. Okay. There is a court case in San Francisco where it involves listings not being on the multiple listing service, MLS, by, TAN, that Top Agent Network thing. So NAR has what they call Policy 8, which makes it a fine to not list a property on the MLS, and the fine is between $5,000 to $15,000. I don't know exactly where the number sits. But both sides in the lawsuit say, no, what we're trying to do is protect consumers. And both sides are saying, well, that's what we're trying to do, is protect consumers. So TAN says it falls under California's new CCPA, the California Consumer Privacy Act, which went into effect, January 1. So you have a San Francisco judge who, there you go, Kevin, right in your backyard, who it gave TAN its first defeat. NAR got a win, but TAN kind of flipped on it and says, man, they got a defeat, but they're saying, oh, we won and we're moving forward and it'll be interesting to watch. And I don't know. Anyway, So lawsuits going on.
There's
Hang
other
on.
lawsuits in NAR.
Can I just
There is
say
another
that
lawsuit. Kevin, go.
I said there's
over
other
the
lawsuits
years,
in Chicago for NAR on how listings are going on and how the 6% or the 5% commission rate, it seems to be somewhat fixed and it's not, quote unquote, not negotiable.
Right.
And so the realtors are facing that big challenge right now of that NAR is facing a huge lawsuit on that side.
Yeah. Your opinion, you think the other side is going to win?
The experts I am talking to on the real estate side are really worried. I'll just leave it at that.
Okay. Okay.
we went to listen to a segment, I don't know, a segment at the NAR conference in the fall in San
Right.
Francisco. They were worried. They're worried.
Okay.
We listen to their alleged people.
Okay.
Yep.
Let's see what happens. Oh, talking about our real estate partners, Realtor.com launched a new housing market recovery index to see how fast the market's coming back. Now, I spoke about this a couple months ago when we saw, the biggest gain in housing in February, and then COVID hit, and then, the whole world fell off a cliff. This index, Housing Market Recovery Index, tracks the housing market's recovery, and they split it up into 4 different areas: online search activity, home prices based on median list prices, housing supply, and pace of sales. Okay. So of the 50 largest markets that they're tracking, now they looked at January 2020 as kind of a benchmark. This is where we were, that's where we were. And they looked at the 50 largest markets. 2 of them are in California: San Francisco, yay Kevin, and San Diego. Looking at the top 10 most recovered markets, 6 of them are in the West. So for us, here in Western US, it looks really, really cool. Among the most recovered markets for home buying interest was Riverside down in SoCal and Sacramento. Hi, Leo Wedden. Hopefully you're tuning in,
Yeah, no, I can testify to that, Dave. I am getting probably equal number of calls for pre-approvals versus refis right now.
Yep.
Oh yeah.
How
And
did
that's
it
picking
way
time.
up?
I mean, all I did all weekend and yesterday was talk to people who are like, I need to buy a house. I need to buy something. I need out of my place. And I'm on the other side of the bay from Kevin. So it's crazy. And we're not seeing we're seeing multiple offers on everything that is priced right and done well.
Yep.
I see, and I'm interested to see what plays out with the whole, in California, or I think it's in the whole state, right? Kevin, you have to deal with the PED in San Francisco, where the and I think it is throughout the state. I think CAR did it, where all the hoops that a buyer, listing agent, everyone has to jump through just to go visit a property. And so there's a bunch of forms to sign, and the pre-approvals, which I'm interested because it does harken back to the meltdown when all the short sales, you had to get pre-approved with their lender. They're not requiring that you get pre-approved with any particular lender, which I think is a good thing. But it's interesting because you've got buyers who are sort of, instead of being, just, oh, I want to go see a house, they have to like commit enough to fill out a loan application, have somebody actually approve them, pre-approve them, and go through that whole process. And I have a feeling that you're just getting a much better quality of, buyer through your open houses, etc. And even with all those hoops that you have to jump, they're getting, I mean, I had some buyers putting an offer in on a place today or tomorrow, and they said that there were 16 people a day that were seeing this particular property. I mean, people are doing it, you know what I mean? So and again, for all of us, it might not be a terrible thing to get these buyers on board so that they are committed to the process and not just wasting everybody's time. So I don't know. What do you guys think?
Oh, absolutely. Housing demand is up, 25% above pre-pandemic levels. So, but the builders are just not keeping up with the demand. Yeah, they're building, but they're just not building enough units fast enough. Kevin, what were you going to say?
I have a realtor that I work with a lot, and he was saying that he's not going back to the old model of doing open houses and hoping people show up anymore. That he is going to do, literally what he does is he does virtual open houses. He does a video of the open house. he schedules a Zoom appointment, and then he does, one house from, 1 o'clock to 2 o'clock. Then he does the next house 2 o'clock to 3 o'clock, the next house 4 o'clock. He goes, I can do 3 open houses and at the same amount of time that it taken me to do one before. I can sell 3 homes in the speed it used to take me to do one. This, I'm never going back.
So
But you're
I mean,
gonna have
I'm
to
wondering
do
if people are
something.
going to go back to an office and just continue to do it online, with like what we're doing right now, with cameras and everything else. I mean, I don't know, maybe commercial real estate might take a hit. Audrey, what were you saying?
I was just going to say, I think that people still want to go touch and feel a place before they buy it. So you're still going to have to let people in. So I'm seeing them. Yeah. But I agree. I think there is definitely a shift, and I think some of it's going to stick. And I don't think it's a terrible idea, actually. So it's a good thing. I mean, the market is strong. There's still a housing shortage. There aren't enough properties for the people who need a place to live. So it's very simple. My son and his friends went to apply for a rental, and he said there was a line around the block, literally, for some, yeah. So it's crazy out there, but it's good for us, and I think purchases are definitely picking up. So all the concerns we had, I mean, assuming everybody gets back to work, right? But in our area, people are getting back to work, or we're never off work. And so I think we're going to be okay around in California, at least. I can't speak for the rest of the country, but we are certainly seeing that things are coming back here.
Absolutely. So I was talking to a purchase couple that are coming back from Amsterdam, and so they're renting a place, but they're checking on the progress of their house. So they are checking on they're walking through the house, the floors, the walls, the colors, the finishes, everything, and it's supposed to be done next month, right? Like to your point, Audrey, they're walking through it, but he is thankfully serving in the military, and I said, hey, thank you for all that you're doing. But he's going to be gone in the month of July when the house is finished. And so I'm talking to her, and I said, so what's the plan? And she says, we're not closing. And I'm like, what? Says, well, he won't be here for the final walkthrough. So like Audrey, you were saying, they want that touch and feel, even though they've been involved in the entire process, from digging the hole in the ground all the way to they put the stucco on, and they're doing all the drywall stuff, so they're getting closer, but the final flooring isn't done. Anyway, so she's sitting there saying, nope, not going to do it. I'm going to just delay it until he comes back from his military service, and then we can walk through it together. So there's something to be said about virtual, and then there's something to be said about, Audrey, what you said, touching and feeling everything. I mean, in the price range that these guys are at, they want to make sure that everything is exactly what they wanted. So anyway.
Right. Well, and I had somebody the other day who they're looking at, and this is like a $650,000 absolute fixer-upper, probably 100 years old, probably a hoarder, lived there before. So I go online, I look at the pictures, and all I could think of is, how does that smell, right? That hadn't even occurred to her. So she was gonna go see it last weekend, and I said, I can't wait to hear how it smells. She goes, oh God, I hadn't even thought of that. But think about that. Like when you go into a property, there's a feel, there's a smell, there's you gotta be cool with all of it. And you can't get all of that through a video. So, all right. So moving right along, let's talk about forbearance, David, because that's always a hot topic for us.
Oh, I didn't want to talk about forbearance, but seeing that you brought it up, go. What did you want to bring up?
Well, so first of all, we have a question from somebody who's asking whether somebody being in forbearance on their auto loan is going to have an impact on their purchase or refi, and the answer is yes, from what I'm hearing. Is that what you're hearing?
Any kind of credit, I don't want to call it a blemish because it can't be counted against you, but any kind of a credit irregularity, yes, will be have to explained and taken care of and stuff like that. Yep.
Right.
Yep.
Right. So, and then also we got some clarification too that so I was having a conversation with a client, and they had gone into forbearance, which I was shocked by because they have tons of reserves, blah, blah, blah. But they were just worried, self-employed, blah, blah, blah.
Nobody knew what was going to happen in the future. They just know, oh my goodness, right now everything, the wheels are falling off and the sky's falling and what the heck am I going to do? So, I mean, I don't point fingers. I understand. Go ahead, Audrey.
So I told him, I'm like, for God's sake, make your payment. If you, I mean, you want to buy this property in July, get caught up right now. And so they are, but it's, you know, it's still an issue. You cannot be in forbearance and refinance or do anything until you're caught up or have figured out something and then have paid 3 months.
Right. It was very interesting, I thought, with Google making the announcement on their ads to combat discrimination. I mean, we've seen the riots, the Black Lives Matter. I mean, everybody's kind of sitting there saying we got to do something. So all the demonstrations, all the, you know, minority stuff. So HUD and Google together worked on changes that are going to go into effect later this year. And I think, I'm not trying to add any gas to a fire that's already going, but I think it's about time. We saw that, you know, Facebook kind of changed their filtering process. Google's doing the same thing. My opinion, it's way past time. We have got to all come together. We have got to stop discriminating. We have got to just, anyway, I apologize that I'm on my soapbox, but it's forefront. It's evening news. We see what's happening. I mean, oh my goodness, Atlanta and the Wendy's parking lot thing. I mean, we just see it over and over and over. And I'm glad some changes are going on. I don't know if it's the end all be all, but at least we're moving in the right direction. Kevin, I saw your head going like this.
Oh, I agree. I just got off my Rotary meeting this morning. We had the chief of police speaking for my town. And he was way ahead of all this stuff. He said, you know, his police officers were actually working with the protesters and they were welcomed by the protesters. But, you know, hey, I live in this little panacea little town. So, you know, it's a little different here, I think. But it's kind of, he was saying that, you know, the guidelines that they have here are so stringent, you know, that kind of stuff just can't happen here. That, you know, they can't even have a bad road police officer because it's a small police force. There's only 33 police officers. They all work with each other, you know, 3 shifts of 11 all the time. So, you know, they all know each other. They're all working with each other all the time. And if someone was of bad ilk, they would know and be weeded out.
Well, but you have big cities. You have LA, you know, you have San Diego, you have San Francisco. I don't know how big Walnut Creek is, you know, Audrey, I mean, it's a good sized city, right? Walnut Creek, where you're at?
It's small. It would be characterized as pretty small. I mean, wait till the census comes out. The sign says 68,000 people. I would say probably a few more than that, but not big.
Okay.
Sacramento,
a bigger city. So Kevin, if your guys' police force in your city is smallish, other cities are kind of a little bit bigger. I mean, look at how big California is. So, hey, with all the states that were loosening up on the COVID thing, it's freaking me out a little bit because I've seen a COVID spike in states that have started to kind of loosen things up a little bit. So I was watching CNN. Well, they talked about the number of COVID hospitalizations since Memorial Day. Now, the reason I'm picking Memorial Day, because we're the 16th today, the incubation period is something like, I don't know, 5, 6, 14. I'm not a doctor, right? I'm a mortgage dude. Let's just say it's a week to 2 weeks. Let's just say it's a week to 2 weeks.
Yeah.
Well, it's a week to 2 weeks now from Memorial Day weekend. And the numbers have gone up in California of COVID-19 hospitalizations, which again has me a little freaked out, a little worried. I mean, everybody's going stir crazy from, you know, being inside all the time. But if you go out and it spikes, I don't know. I'm just nervous.
Yep. I think we're all watching it and, you know, hoping for the best and preparing for the worst. So please don't tell me my gym has to close again. That's all I care about at this point. It is, okay, so I have a comment here that it says, I had just received a referral this morning and am told the borrower needs to provide a thumbprint with her application to Wells Fargo. I have not verified but the referral comes from a good source. Have you heard of this? Doing thumbprints?
When you go to open up an account at a financial institution, so let's say they were never a customer of Wells before, Wells, and any other financial institution, bank or credit union does do that. I have seen that. So, okay, Kevin, to your point, you mentioned, a particular company. I try to be super neutral all the time. Audrey, you mentioned a different, financial institution. So if they have these killer rates and people are shopping, and then so they call a financial institution that they don't have a relationship with, the financial institution says, well, wait a minute, you got to either be a member of the credit union, or we'll take a quarter or a half off the interest rate if you have your checking and you have your car loan and you have your credit. You know how they do that. So yes, in order to open up an account or begin that relationship, they do ask for a thumbprint. Yeah, they do. Yeah, they do.
Interesting.
I saw that.
This is point of reference from our North Bay president, Brenda Cantu, who I adore. She
Hi, Brenda.
recommends Reid Hoffman's commencement address to the nation's graduates regarding seizing opportunities for our dramatic evolving economy. She says it's good for MLOs too. So check it out, people, if you're interested. Moving right ahead. When will Fannie high balance rates come down? And, again, we talk about the de minimis pretty regularly now and what a challenge that is in the sand state. So there you go, David. Talk to us.
No. My market is different from your market. So as in Sacramento and Lincoln, and as we're a little further away from the coast, we're not San Francisco, we're not San Diego, we're not Santa Monica, we're not Monterey Bay, we're not Santa Cruz. So don't
You
laugh.
can get a nice big number in my neighborhood for 1.2, David. I mean, it's cheap. So
Yeah.
okay, so just to recap,
600 and something thousand as a fixer upper, I'm going,
oh no, that wasn't here. Trust me, that was definitely not here. Okay,
Yeah.
so let's go through the whole de minimis thing again, shall we? So only 10% of what you sell to Fannie and Freddie can be high balance. Anytime that you go over that 10% number, a lender goes over that 10% number, there is a premium that they pay for that high balance product. So that is why the high balance pricing is high, is because there is so much more volume in the high balance arena, and it well exceeds 90% or 10% for most lenders. So and for a while there was no market for it. People didn't want to buy the servicing at all.
Yeah, that's why the banks, because they're not selling it to Fannie and Freddie, they're keeping it. And again, I won't mention any names, but you guys know who they are. The banks can be extremely competitive. Kevin, I don't know if we were live when we were talking about it. You priced it out at 3.7, 3.8, and the bank was doing it at 2.3. High balance.
Jumbo.
No, not high balance, jumbo.
Yeah, that's different. So I was pricing.
I can't even compete with that. I did, I know what you're saying, Audrey, when you have these bigger loan amounts, I know what you're saying. I mean, in Lincoln, the loan amount balances are somewhere between 400 to 600 in, the area that I'm in. Okay. So I can't compare myself to, Kevin, where, you're turning away $2 and $3 million deals. I'm sitting there thinking, man,
it hurts. And by the way, I heard my Wells buddy, and they don't take a thumbprint for a loan application. So that must have been for a open up a checking account or savings account.
I have a relationship with them and stuff like that. Hey,
and I bet though that in order to get that 2.3, you have to. My guess, I don't know for sure, but I'm pretty sure you probably have to a nice chunky balance.
Hey, Governor Newsom, and this is not that old. But we haven't talked for 2 weeks, right? He still wants to reorganize DBO. So just as we think, okay, everything's starting to settle down, he wants to, and he did this in his January budget stuff, that he wants to create a new Department of Financial Protection and Innovation. So whatever the heck is DFPI, is that what it is? Department of Financial Protection and Innovation, because he's sitting there saying, well, the CFPB is kind of toning down their enforcement efforts protecting consumers. So California, we're going to do our own. So he wants to fund $44 million for the first 3 years of this DBO migration, because some of the people on this are either DRE or DBO. So of the DBO folks, you're thinking, well, Dave, January was so long ago. Hang on. He updated his budget May 28th at about 3 in the afternoon. And he says, no, I still want to move forward with it, even though the state has seen a $41 billion decline in revenue because of, COVID and everything else. So they want to establish that state version of the CFPB. Thoughts? What do you guys think about it? I don't like it.
When we met last with the banking, when we were in Sacramento last, which was a year ago, I don't know what month, it's all a blur. Anyway, and we met with the head of the banking committee, and we asked about this idea of a California CFPB. We were told that they were focused on the, the short-term loans, the payday lenders. That was what, and the DBO, if you recall, is huge. I mean, the number of licensees or different people they cover is literally, the last I heard was 400,000. It could be bigger than that at this point. So if that number isn't exactly right, I apologize. But that was the last number I'd heard. So they were stretched to the max, right? So
right.
Again, our understanding was that the mortgage industry was not supposed to be targeted with this new iteration of the DBO / CFPB California style. But
right.
As soon as this COVID stuff dies down, the governor is on my short list of people to converse with, because they need to really be clear on what they are talking about and how it translates down, and how we want to make sure we don't go back to, pardon me?
Unintended consequences.
Right, we don't want to go back to,
or the car title people, or the 500% interest people, whatever. But hey, mortgage might be involved in that. Yeah.
We don't want to go back to being regulated by enforcement. We want to have a regulatory agency like we've always had with the DRE, where they're interested in making sure they get the bad guys, and they want to help the good guys be good, and understand that we just want to be compliant. The good ones are the ones, those are not the people you need to be worried about.
The game, we'll play it according to the rules, but just don't discipline us and then say, oh, you broke this rule, which we just made up. Yeah, totally.
Right.
Totally.
And when we have questions, answer them. Don't just fine us and then we get the answer. So that's
Go ahead. Sorry.
Well, so that's, again, so yes, we're aware of this CFPB California style. I don't know what to call it, because I can't remember what your acronym was. But anyway, we're aware of it. We'll watch it, and but good Lord, that's all we don't need.
My big concern is
protection and innovation.
Yeah, but my concern is they're seeing how much revenue the CFPB is generating. And, they do it on fines. That's their only source of income. And that's why he'd be willing to dump that kind of money into creating another one for California, because he's seeing the revenue that can be generated from
it. Yeah. So, hey, stock market is way up. I think it was just up over, I've seen it today up 800, 600 points. Why? Commerce Department reported a spike in retail sales because everybody was, at home and we couldn't spend any money. So after the shutdown, they're sitting there seeing a whole bunch of spending. So whoop, there you seeing, a spike go up. Dow Jones, NASDAQ, everything is up. So it's kind of cool. People are coming out and starting to spend money. So that's cool. Fed funds rate. Fed says they're not going to raise rates for the next few years. And a previous question when we got together on inflation, we talked about that there will not be inflation for the next few years. I'm going to put a year on it. I'm thinking we're not going to have inflation for probably 5 years. Inflation is
deflation.
Kind of a little bit, but it's not going to be like anywhere near the numbers of like 2% inflation. Not for years and years. So anyway.
Yep, they're talking about deflation, that's what they're concerned with. Okay, a couple of things. So Jenny Garcia just joined as an associate member. So we want to say welcome to camp. She's on the webinar right now. Thank you. So, and join us on Thursday for the brainstorming session. And the same thing to the person who is asking, what lenders does everyone use for commercial lending for 2 million plus warehouse? So, you know, get on the call on Thursday and we'll see if somebody on there. We actually had a commercial guy, he's a member on there 2 times ago, so maybe he'll be there again. But anyway, because I don't know the answer to that. Do you?
I don't. Well, there's lots of commercial lenders out there. I do commercial, but I don't do it enough to sit there and say, oh, I would go this place or I would go that place. I don't want to.
Right.
A local community bank is your best option on those.
Right.
So David, what?
And they protect brokers, Kevin?
Pardon?
And they protect brokers?
Depends.
Yeah,
depends.
Yeah, that depends. But yeah,
Okay.
they can.
Okay.
Okay, so David, quickly, what is replacing LIBOR?
SOFR, SOFR.
So far as you know.
So far as I know, yes. So that we understand what's going on, LIBOR was manipulated, and so everybody's like, saying, nah, you can't have something manipulated. And so SOFR stands for the Secured Overnight Financing Rate, and just in the name, Secured Overnight Financing Rate, it's what banks are actually charged for borrowing money overnight. It's what LIBOR should have been doing, but what SOFR really is doing. And so, guys, it starts in 2 weeks, and if you do a loan, your lenders are going to start cutting back on LIBOR as an index. It will be done and gone 6 months from now. You will not use LIBOR again.
How do the rates on the SOFR compare to LIBOR?
They're not like 1-to-1. They're not even, because remember, LIBOR was fake. It wasn't real. And so it's like you can tie it to gold or tie it to an AT&T share of stock or tie it to the price of an iPhone, right? This is totally fake. Like, Kevin, the air that you're breathing, well, how much air are you breathing and what's the value of, the price of that? So it was totally fake. So what there's going to have to be is if we are moving to SOFR, there's going to have to be what kind of an adjustment do we need to make off of a fake index to come up to this real index? I'm kind of thinking it's going to have to be more than LIBOR. Okay, so it's LIBOR plus something to get to SOFR. And then once we get SOFR, it should be pretty consistent now and forever.
So we'll do a little more research on SOFR and see what evolves out of that. The acronym is kind of cracking me up every time you say it. Yeah, it's sort of like when you were talking about the NAR lawsuits in TAN, because you have joked about you being TAN so many times over the last few years. And so every time you say the word TAN, you pop into my head, even though you're right in front of me on the screen. Anyway, so there you go. Okay, so a few more questions about FHFA and Fannie and Freddie. So what will happen to their stocks once they come out, once they're out of conservatorship? And is there any chance of the DTI max going up before they get out? And I'm like, no, I don't think so. But what do you think?
No, Fannie and Freddie are actually bringing that back. So, we talked about, 43% DTI, where we knew, what was it, 2 years ago, that you could go up to a 50%, and then it's a 45% max DTI, and everybody was like trying to push it 44.999. You know what I mean? I don't see it going up. I really don't. Kevin, your opinion?
Well, we did an opinion letter from camp to address this, and we took the route of more of a VA loan, where they, it's kind of a sliding
back-end ratio. Yeah,
exactly. And we were told that no one was going are thinking the way we were, that that MBA was dead set on the 43, and a couple other people were, but we actually got good feedback from the CFPB on it when we approached it to them, and they seem to be somewhat open to the idea that maybe the 43 isn't a dead stop. So we'll see.
All right.
I have an opinion about that, shockingly. So when we are talking about 43 or talking about DTIs in general, I think that we can all agree that our underwriting guidelines have not exactly kept up with the way people are paid these days, the way people live these days. And so when you're doing a higher DTI, it is typically for somebody who has income that you're not allowed to count. So let's say your parents are living there, or you have a roommate, or let's say your spouse is being paid in gigs or jigs or whatever the heck that is, and or whatever, like a million different reasons that we can't use. You have an ADU and you have rent that you're showing on your tax return from the ADU, but because it's not zoned a duplex, you can't count it. Like, how many times do we have situations where we are not allowed to count income that actually exists, has a history,
we can verify it, and we can prove it and show that the borrowers received it? You're absolutely right.
And they don't care even the slightest. So that has been like, so I was recently on I'm on the GA committee for NAM, and this conversation had come up because, and especially in the areas where they're doing a lot of first-time buyer purchases, etc. The message was, you better, anyone you have pre-approved in the last 6 months, you better rerun them right now, because those approvals, they have tightened up at the Fannie Freddie level big time. So you may not even get an approval at 43 right now. So the FHFA and those GSEs have definitely, they're drawing a line in the sand as far as what borrowers they want. They want those high DTIs to go to FHA. They're not interested in them, and I don't see them going up anytime soon, because that is not their target. And we can ask Freddie on Thursday. We'll see how far I can push him without breaking the poor guy. But and I promised myself I'm not going to grind him on LLPAs, because I've got to. Huh?
Because he may not.
I love him.
Oh, I don't want to talk to those people.
I've literally argued with him from San Francisco all the way to Florida about how I think their algorithms are not always reflective of reality. But anyway, so I'm going to try and behave, but we'll see what he has to say about some of this stuff on Thursday. It's yeah. Oh my goodness. Sorry.
Rates are amazing. This past week, my goodness, conforming has dropped. See, Kevin, do conforming, man. Rates have dropped like 20 basis points. FHA down 15, VA down 12. And again, it's not like it's always going up or it's always going down. There, it's jaggedy. Jumbo, it only fell, but it did fall 6 basis points last week.
We'll take it.
Absolutely, we will.
Yeah, in the right direction.
More money, which they are, and more people are going back to work, which they are. I'd love to see those trends continue, but we'll just have to look at the numbers. I think all in all for the industry, oh my goodness, things are looking fabulous for the near future.
Yep. So we're getting towards the end of our time together, which is always just a little sad for me. Makes me a little teary, David, because I always miss you. So we're being asked if there are any updates on AB 2501. The answer is not today. We should have something by next week, though, and that is where they are trying to make it so that if somebody goes into default, that they can't start collecting or start the foreclosure process, not start collecting, but start the foreclosure process until 180 days after the federal disaster or the disaster has been deemed over. So, for instance, like some of the fires, right, that we've had in years past, they still haven't ended that disaster period, which means that those people, if this were in effect, could in theory not be making their payments and not be foreclosed upon right now. So, and it's not just houses, it's cars, it's other things too. So we are very much aware of this and very concerned about it, because it will definitely impact lending in California, which is not okay. And so we are really running out of time. David, is there anything you'd like to say before we wrap up?
The intentions of the legislature to protect people. I think that's admirable, and I think it's great. But the solution that they're proposing is wrong. It's absolutely dead wrong. Meaning, so you're the landlord, and everybody thinks, oh, well, it's the wealthy landlord. Stop. It's not everybody that's a wealthy landlord. It's a family that had a home that they moved out because things are bigger and now they have this piece of property that's rental. Okay, cool. So if the state wants to propose that landlord not get their rents because the renters, because of whatever difficulty, can't make the rents, I understand, that, you've got to protect those people. I get that, but not at the expense of the private homeowner. If the state wants to solve the problem, then have the state come up with the money, okay? And not the individual private, property owners. Sorry, that's the way
you are 100% correct. And that is, I've been thinking a lot about this because I'm like, God, we are constantly battling, rent control and all of these different laws that they're trying to enact. And the tenants' rights groups are so active and they are so involved with the legislators. And so, and not just at the state level, but at the local level, the city councils, it's unbelievable how out there they are. But the solution for everyone is always on the backs of private homeowners, and that's not okay, in my opinion. So this is something that is near and dear to my heart. I really believe that we need to figure out a different solution, and that's what we all need to be thinking of. What is the solution? Because they're always looking for revenue, right? That's their bottom line. Every single time you talk to them is, all right, so if we don't have the income from here, how are we going to pay for it? Well, if you're telling them, well, the private homeowner shouldn't pay for it, then who is? Well, I think it's a function of government. If you want, expand Section 8, do whatever you got to do. But anyway, it's complicated, but we are constantly asking private homeowners to subsidize public housing, and that is insane. All right, well, on that bright note, let's just do another recap of things are better. The industry is better. Everything is sparkly and beautiful. So
everything's awesome.
Oh God, I hate that song. Yes. It's a long story. It has to do with this Oscar. I had to watch the movie, which I thought was god awful, and now I associate the movie with the song. All right, that is more information than anybody on earth needed. And with that, I hope we see everyone on Thursday at 11 a.m. with Anthony Hutchinson with Freddie Mac, and then again on Thursday at 5 p.m. because can we ever really get enough of each other? For our camp happy hour, social hour, brainstorming mastermind session. And with that, have a wonderful day.
See you guys later. Bye.
Hey, David.
Thank you, David. Thank you.